we can see that by going to a WACC of 1% higher cost of capital, our stock is, significantly down, and if we had a lower cost of capital, almost double. So you can see how sensitive WACC is. So it's super important to get the right cost of capital and the right cost of debt. Again, we used the book value and we just calculated the percentage of interest over debt. I would, if I was doing a much more in-depth analysis, would dig a lot deeper to look at the bonds and what they're trading at and the yield to maturity and so on. So if you can get yield to maturity, which many of your stocks provide that, use that number as the cost of debt. And here we have our terminal value growth rate of sales forever. This is like going to grow at 1.2% forever. If we were to adjust these growth rate assumptions, you can see, having a lesser growth rate obviously reduces our stock value. So again, these are things that all come into play into your stock analysis. So you don't have to do a sensitivity chart here, but it would add some value to know that, wow, if I'm off by 0.5%, could really change things. So I'm going to include this. Again, I'm not expecting to do this. It does add some value. Then yeah, just come up with our conclusion. You don't have to really. Just you could recommend. What's your recommendation? Based on the following assumptions, etc. Review the stock as being undervalued compared to the current market price per share. Something along those lines. But again, the sensitivity shows, wow, if we're off by just a tiny bit in our WACC, that stock price really changes in terms of what we feel is a fair value. Because the stock is trading at $61.50 and we've got it at 72. I'm just going to do the math here real quick. So 72.35 over 61.50. 50 or 51? 51. Subtract 1. So there's a 17.6% upside. 17.6% upside, growth potential. We view the stock as being worth 17% more than what the market is trading at. That is today. And if you wanted to do it in 1 year from now, what do we think this will be worth in 1 year? You just use the WACC. Just discount, instead of discounting it by 5 years, discount by 4 years. Bring everything to next year. And you find what the 1 year target price is. But I think this is sufficient. Okay, I think I've provided a pretty good structure, how I would write this. This is now 20 pages, and I haven't, I'm going to sift through, oh yeah, cover page. So yeah, cover page, just a quick 3 or 4 lines, 3 to 4 lines of what the business does 3 to 4 lines on business segments. I.E. How do they make money? Loblaws has the financial sector, the retail sector, and I think there's the property income sector. Stock performance. Where's the there we go, quote. Okay, you might want to just include a little tidbit on the stock performance. The financial base case, or you know what, you could just do like a bar chart, something from their investor presentation. Where is it? You know, just a bar chart of how their sales are planning, including forecasts. So, along those lines. And then your valuation price per stock, and maybe a quick recommendation. There you go. That's everything you need to know. That's everything I need to know in one page. What is the company? What do they do? How have they been performing? What's their outlook? What do you think it's worth? What do you recommend? That's one page. Then your analysis goes into more depth. Company, business description, you know, general performance, SWOT analysis, competitors, market. So important for helping us with our forecast. The sector, capital structure of the company, more in-depth analysis on the stock performance, financial table, some details on how they've been performing, operating income, cash flow. Operating income has to do with their costs, what costs are driving year to date, forecast, base case, down case. You're creating scenarios. How does that impact on sales? Take a look at our base case. You could also copy your down case if you wanted. Where was our down case? Copy your down case if you felt like it. Make mention that you've removed $440 billion of future sales. You know, so you've really stressed this. I think it's actually overly stressed by 20%. I would re-look at those numbers. Where's our down case? Down case. Impact on sales. So we've got our down case here. We've got our base case. I'd probably put the base case up here. And then you've got your valuation, sensitivity analysis, and there it is. Anything that's above and beyond, like history, and give more detail on the industry, WACC calculations. You could put your full financial calculations in here if you feel like it. This is subsidiaries. Probably goes up more towards the company. That would go up for the company description, company details. Anyways, that's your stock valuation.